So again, this chapter is on activity-based costing, variable costing, and absorption costing. Now, absorption costing, you're already familiar with. You've just never heard that term, but it's what we normally do. So really don't worry about that because it's not really anything new. Variable costing is going to be a new concept, and basically it's where you break out your variable costs from your fixed costs. So that's not completely strange. You know, we've done some of that before, but we'll see how to make, for example, a variable costing income statement. Most of the chapter is going to be on activity-based costing. And this really has to do with how you apply overhead costs. So far, we learned that you have to come up with an overhead rate, right? So you can estimate how much overhead cost you apply. And there were three traditional methods we used to come up with an overhead rate, right? What were the three different activities we can use to estimate the overhead rate? Labor hours is one. Machine hours. And the third one, labor cost. Okay. Those are the three traditional methods. In activity-based costing, you can use all kinds of other methods and you can combine them. So you can have multiple ways that you calculate your overhead, as opposed to the traditional method where you just picked one method and that was the only method that you used. So it does get a little complex sometimes in terms of the calculations. There are going to be some cases where we've got 5 different activities we're using to figure out our overhead costs. So compared to just using one activity, now using 5 activities, it's going to be more calculations that we're going to have to do. But overall, I really don't think this is that hard of a chapter. It's a little bit on the short side. So I think we'll probably get through it without too much anxiety. Okay. All right. You guys wrote your name down, right? Okay. All right, so this is what we're going to cover in this chapter. So we'll look at the different cost drivers that we can use other than machine hours, and labor costs. And we'll figure out how to use those activities to figure out the overhead cost and then apply that to our total cost. We'll have some exercises and problems where we use the traditional method and then we use the activity-based costing method, which again is sometimes called the ABC method. And we'll just do a comparison and see, well, what happened when we use traditional, what happened when we use ABC, and which is a better approach. The short answer to that is ABC is a better approach. It's just that it takes longer. Then let's see, then we get into variable and absorption costing. Again, absorption is a new name for something we are already familiar with. And variable is going to be a little twist on what we've done in the past, okay? So we know the basic overhead formula, right? To have an overhead rate, you need to estimate your overhead cost, divide it by whatever activity you're using, like machine hours or labor cost, and that gives you your rate, right? Okay, and we'll use that same formula in this chapter quite a bit. So let's see. Yeah, okay, that's basically the same thing we just said. All right. All right. There's an example we're going to go through here. It's a company that makes recorders, meaning the musical instrument. You know, it's like a kind of like a flute that you play this way, right? And they've got 3 different levels. They've got the solo recorder, which is basically their basic introductory level recorder, like the kind you might use in an elementary school. But then you've got the band level recorder. So this is a little bit higher quality, and costs a little bit more. And then they've got the orchestra level recorder, which would be their top of the line. Okay, so 3 versions of the same product. We can see the material costs for each of their 3 products and the labor costs. Now, I don't know why the solo recorder takes $10 per unit, and the orchestra only takes $4.30. And then the band is $2.75. That doesn't really make sense to me, but these are the numbers they gave us, so okay, we'll just go with that. But what we don't know is the overhead costs, right? Manufacturing overhead depends on the rate, right? We need to use that formula that we saw to come up with a rate. Once you come up with a rate, you have to multiply it by the activity to know how much overhead to apply, right? Okay, so here the company has estimated their overhead for the year is going to be $2.5 million. And they're going to use direct labor hours as the way that they're going to allocate overhead costs. And they have estimated 1.25 million direct labor hours. So when they divide the estimated overhead by the activity, they come up with $2 of overhead per direct labor hour. So now, as they're going through the year and they're making these recorders, they can apply overhead costs. It's an estimate, right? Might not be 100% correct. It's probably not. But at least it gives them an idea of what's the cost of overhead for their different recorders. So now that they have that rate of $2 per direct labor hour, they could take the number of direct labor hours for each version of their product, multiply it by the $2 rate, and come up with the total amount of overhead that they're expecting for that year for that version of the product. Everybody following so far? Okay. And then you can divide that by how many units they expect to make, and now you get your overhead per unit. So for the solo product, they think it'll be $5 of overhead. For the band, $8. For the orchestra, $4. That's kind of interesting because remember the band had the lowest labor cost, but for some reason it has higher overhead costs. So maybe they're using more machines or something. I don't know. Some overhead cost is higher for the band version, even though their labor cost is lower for the band version. So I don't know what's going on there, but it doesn't matter. Okay, so now we can take that per unit overhead rate that we just calculated and add it to the material and labor cost, and we get a total cost for each version of their product. Okay. Now you can subtract the total cost that we just calculated from the total price, and you see the gross profit per unit of product. So that's why we need to do this, right? That's why we need to go through this process of coming up with an overhead rate, applying it, and then figuring out how profitable is each product. So if this is correct, when we sell a solo product, we make $1.50. If we sell a band product, we make $8.25, and if we sell an orchestra product, we make $10 of gross profit. Right? We've got some other administrative expenses, but just looking at the gross profit, that shows us that the orchestra product is the most profitable, right? However, there aren't that many recorder players in the orchestra. So we're probably selling a lot more of the solo product, which has a cheaper sales price. Okay, so really there's nothing new so far. All we're doing, we're using the traditional method to apply overhead and see what our costs are. All right, So then you can multiply the number of units that you're planning to produce by the profit per unit. And we see we get gross profit for the solo product, for the band product, and for the orchestra product. Oh, actually, interesting. We're selling more orchestra recorders than solo recorders. Okay. These are made up numbers. So that's why maybe they don't always reflect what might happen out in the real business world. Okay, so we already have an exercise to do. What do you know? Now, this is based on traditional overhead costing. So this is something we've done before. Really haven't gotten into anything new yet. And let's go ahead and work through this one. Exercise number 4. So open up your exercise set if you can. All right, and it says that this company makes small and large blankets, okay? So they've got 2 versions of their product, small and large. They have $350,000 of estimated overhead. They are planning to make 75,000 small blankets, 25,000 large blankets. Got it? And we have to figure out the overhead rate, but keep in mind their small blanket takes 1 machine hour, large blanket takes 2 machine hours. So I'm going to remind you of the formula. We take our estimated overhead divided by what?
Estimated activity.
Yeah, the estimated activity, exactly. And that's going to equal our overhead rate. Now, in this case, we don't have any information about direct labor cost or hours, right? So what's the activity we're using in this case? Machine hours, right? That's all we have to work with. So what we have to do is first put in the estimated overhead cost and then divide that by the estimated number of machine hours. What's that? Okay. All right. And then once you divide, you will get your overhead rate. So that's your mission. Go ahead and take a moment to try to figure that out and see what rate you come up with. Nobody reminded me. Luckily, I remembered this time. Okay. So yes, the estimated overhead, they said, is $350,000, right? That's the easy part because they gave that number to us. What is the estimated activity? 125,000 machine hours is right. So how'd you get that, Audrey?
So 1 machine hour for each of the 75,000 small blankets,
Okay.
and then 2 machine hours for each of the blankets.
Exactly. So there are 75,000 small blankets that each require 1 machine hour, right? So that's 75,000 machine hours. But we have a second product, 25,000 large blankets that each take 2 machine hours, right? So 25,000 times 2 is 50,000. So you have to calculate the activity for each product and then add it together. And that's how we get a total of 125,000 machine hours. 75,000 for small, 50,000 for large. Together, that's 125,000. And that comes out to 280, was it? Which means $2.80 of overhead per machine hour. Okay? So that's how we come up with our overhead allocation rate and then apply it. Well, we would apply it once we knew how many machine hours we actually used, we would multiply it by that rate to apply the overhead. Okay. And again, it's nothing new, right? We've been doing this the last couple of weeks. So any question on traditional overhead? Okay, good. Then let's go on. So what this slide is telling us is that a lot of times as companies get more sophisticated with their machinery, they don't need as much labor. We've talked about that concept a little bit before, how when you invest sometimes into fixed assets like equipment or software, it can reduce your need for variable costs like labor. Now, the traditional methods that we use, again, are machine hours, labor hours, and labor costs. So as an organization really shifts away from using as much human labor, then maybe you need a new way to figure out your overhead costs and how to apply them, right? You're not using as much labor, then what are you left with? You could use machine hours, or you could use activity-based costing and look at some other ways to figure out what's the right way to allocate overhead against your different production that you're doing. So that's really why we're talking about this activity-based costing. Now here's an interesting question. Why don't we just wait until the end of the year when we know what our actual overhead costs are, and then figure out what they were, how much to apply to different jobs? Emma?
You have to apply it for each batch with expenses.
Okay, so we do want to apply it to every job or every process, right? Depending on if we're doing job order or process costing. And that is correct, but we could do that at the end of the year, right? So why not? Why not wait till the end of the year to apply those overhead costs more accurately? Yes, it does. Yeah, it does, because our overhead costs are part of our cost of goods sold, right? And so in any period where we're reporting, like every quarter when a corporation has to report its finances, they need to know what their costs were. And most companies, from my experience, produce financial statements at least monthly, even though they don't have to, but they do it for their own benefit. And wouldn't you think the managers in each department want to have an idea of what their costs are, right? So that's why we have to estimate our overhead, apply it using our rate, and then at the end of the period, look back and make any adjustments based on what our actual overhead costs were, right? We had the estimated overhead, applied overhead, and actual overhead. Okay, so good. So far, we've looked at the traditional activities. Here are some examples of some other activities we could use to estimate overhead, to figure out how much to apply to a particular process or job. So, for example, customer service costs. And we might base it on how many products got returned by customers. You might be thinking, wait a minute, customer service, that's an administrative cost. That's not a manufacturing cost. Well, welcome to ABC. In activity-based costing, you can use non-manufacturing costs to estimate overhead. Now, remember that what we're doing in this class in managerial accounting is not GAAP. It's not going to anybody outside the organization. It's only for our internal use. So if we as a company think that there are a lot of customer service costs associated with our overhead, that relates to manufacturing, we can include that. Cleaning equipment. The costs we have associated with cleaning our equipment might be associated with the square footage of our factory and how much equipment we have. Or maybe I'm misinterpreting this. Maybe this is equipment for cleaning. Either way, it might be associated with the square footage of our factory. Marketing expenses, that's also not manufacturing related. If we have like a search engine optimization program that's out there trying to get people to our website, that's a marketing cost. But hey, that might even be part of our activity-based costing. And we might base it on how many customers respond. Okay, office supplies, based on the number of employees we have. If you're a florist, green floral tape, which would be based on the number of customer orders, and website maintenance based on the number of online orders. So these are very different from machine hours, and labor costs, right? But if the company feels like these costs are the best way to figure out how much overhead to apply to a particular job or process, the company can do that as long as it doesn't share that information outside of the company, right? Because investors would not understand what's going on. So activity-based costing does allow us to really get a more precise estimate of the cost associated with a particular job. Because we can use multiple activities and pretty much any activities we think are relevant, it allows us a lot more precision in coming up with those estimates. But it is more work. Means more data you need to gather, more calculations you have to do. So more accurate, but more time consuming. Step one, identify your cost pools. Okay, that's a new term. Before we were estimating the total overhead cost, right, for the year. You know, manufacturing overhead is everything that's not direct labor and direct materials, right? So it's a lot of stuff that just went into that one big bucket of manufacturing overhead. But now we're breaking up that big bucket into different pools of costs. So you might have costs associated with setting up your machines. Take some time, might take some certain supplies that you use to set up the machine. You might have costs associated with your purchasing process. Large companies often have a department and all they do is purchasing. So there are costs involved with purchasing. You might have costs associated with inspections of your products, with assembling your products, or with technology like machine hours, right? Machine hours is a traditional activity, but we will also see it used in activity-based costing. So here's an example. This company has these 5 different activities, and they have associated overhead costs with each of those 5 activities, okay? So remember the recorder company estimated they had $2.5 million of overhead. Well, same thing. This company is also anticipating $2.5 million of overhead. But they've broken that down into these 5 different cost pools. So they've got overhead associated with setting up the machines, purchasing the material, etc. And it all totals up to $2.5 million. Okay? Everybody following so far? Okay, now they need to know the activities associated with each of those 5 cost pools. So if one of the cost pools is setting up the machines, well, how many times are they going to have to set up the machines? So it's the same concept where we're taking estimated overhead and then we're going to divide it by the estimated activity. That is 5 different categories this time. So another activity, the one related to purchasing material and all of that overhead. The activity is going to be the number of purchase requisitions. Every time an employee submits a request for a purchase, that's one purchase requisition, right? And that could be an activity that we track. How many hours are we going to spend on inspection? That could be another activity. How many parts do we need to assemble? That goes with assembling products. How many machine hours? Again, that goes with technological production. So now we've got 5 cost pools, and each one has its own activity. And then we have to estimate how much of that activity. So here we're saying for machine setups, we're going to have to do that 2,000 times for the solo product, 1,500 for the band, 1,500 for the orchestra, and that gives us a total number of setups. So just like we just did with the blankets, remember, we had to figure out the total number of, I think it was machine hours for the blankets. Here we have to figure out the total number of machine setups for the recorders, total number of purchase requisitions, et cetera, et cetera. Why do you think we need that total activity amount for each of these 5 activities? Emma? Because we're going to divide it, right? We're going to take the estimated overhead for that cost pool, divide it by the estimated activity, and that will get us our rate for that activity. So we're going to end up, in this case, with 5 different overhead rates. And we're going to have to then multiply the rates by the actual activities and total them up. So as I said, a lot of calculations in this chapter. So that's what we see here. Oh, this is the division. We're taking the overhead costs in each of these 5 categories, excuse me, divided by the activity in each category to get the rate for that category, right? And then we take the actual activity, multiply it by the rate. So you see for the solo product for machine setups, the 2,000 setups times the $40 each comes out to $80,000 of overhead just for that product type and just for that, excuse me, activity. So we have to do that calculation 5 times for each product. We'll get some water in a second. But everybody following me so far? Really the same thing we were doing with the traditional method. It's just we're doing it now 5 times, right? For the same, and for 3 different products. Okay. Excuse me. So once we go through this process, we figure out how much overhead in each cost pool for each product. We can get the totals by cost pool, which add up to 2.5 million, and the total by product, which also add up to 2.5 million. Okay. Then we could take the overhead per product, divide it by the number of units of product, and we get our overhead rate per unit. Okay. Just like we saw with the traditional approach, we got there, it was just more calculations to do it this way. So now we have these 3 overhead rates. If we then plug those in, we add them to the direct labor and direct materials, we get our cost per unit using ABC costing. In this case, our solo product turns out the most expensive. Now remember, I said the ABC method is more precise, more time consuming, but it's more precise. So it might be worth it to go through that process and see, wow, this our cheapest product has the highest cost. That might be a little bit of an issue, right? Because when you subtract that from the sales price, we're now losing money on every unit of our solo product. When we used the traditional method, it looked like that product was profitable. And here, using the ABC method, we got a different result. That's good to know, right? If a product is losing money, we want to know that. Then you can multiply by the number of units that you sold, and we see that that solo product is losing us $375,000. Now, from a marketing standpoint, it might still be worth it to offer that product because maybe that gets people in the door. They start off with your cheaper product, and then later they advance to the more expensive one. Or you might say it makes sense for us to lose money on this product because if we discontinue that product, our competitor is going to take that market share, and then they'll give more brand recognition. So from a marketing perspective, it might or might not make sense to continue that product. But from a financial perspective, not good, right? Okay. So, any questions or comments so far? Okay. All right, so as you've learned in the traditional overhead costing method, you pick one driver, machine hours, or labor cost, and you use that all the time. In the ABC method, you can have multiple drivers. It makes sense to use the ABC method if you use a lot of technology, if you use a lot of direct labor in your manufacturing, then maybe it makes more sense to use the traditional method. With the traditional method, there's only one overhead estimate, right? And because you have only one estimate and only one activity, it's not a very accurate approach. On the other hand, with ABC, because you have multiple pools of overhead and multiple activities, you're more precise in how you apply your overhead cost. It's going to be the same amount of overhead either way, right? It's just how do you divide it up among your different products. And as we've learned with ABC, you can use non-manufacturing costs, which might give you a different insight into how much your product really costs. It is more time consuming to do ABC, and time is money. So that means there's going to be more cost involved in the actual calculation of your costing. Okay. So here we see a comparison for the same recorder company. When they used the ABC method, these were the overhead costs that they came up with per unit. With the traditional method, these were the costs per unit. And what we see here is the difference. So the band product was pretty close. It didn't make that much of a difference. But you could see with the solo product, it was a $4 difference in overhead per unit, depending on the method that was used. And with the orchestra product, $2.30 per unit. So for this company, I would say the ABC method is worth the extra time and effort to get a more accurate view of what's going on with your overhead. Okay, questions, comments? Okay. Ooh, an exercise, all right. Yes, okay, so go ahead and go to your exercise set if you can, because we have a table that'll help us with this one. Okay. This company has two products. They've got polyester hats, poly for short, and they have silk hats. They have two cost pools. So there's a setup cost pool and the estimated overhead associated with setting up their machines is $100,000. They also have an inspection pool, which is overhead associated with inspecting their products. And the estimated overhead is $25,000 in the inspection pool. Now the Poly product, they're expecting to have 750,000 setups, 17,000 inspections. Okay, that's for Poly. And then the Silk product, they are expecting 250,000 setups and 80,000 inspections. So here we have only two products and only two cost pools. What we have to do first, figure out the rate, the overhead allocation rate for each cost pool. Okay. Once we have the rate for each cost pool, then we'll apply it to the number of setups and the number of inspections for each product to figure out their total overhead costs. Okay. That's what you are tasked with. Any questions on how to begin or what to do? Okay, I'll give you all a couple minutes to work on that while I go fetch some water, and we'll see how you do. And so I heard 0.1 is the overhead rate. Is that for setup or inspection?
Both.
For both. Okay. And that is the right answer. So let's review that. With setups, overhead was $100,000, right? That's the estimated overhead. We divide that by the estimated activity. So for setups, we're looking at 750,000 for one product, 250,000 for the other. So you add that together, that's 1 million setups. So when we take $100,000 of overhead, divide it by 1 million setups, it comes out to 10 cents per setup. Right? 100,000, no, yeah, 100,000 overhead divided by 1 million setups. Oops, that's not 1 million. And that equals 10 cents of manufacturing overhead per setup. So that is correct. And then we can do the same thing with inspection. There we had $25,000 of estimated overhead. 170,000 inspections for the Poly product, plus 80,000 for the Silk product. So you add those together, you get 250,000 inspections, right? So take $25,000 of overhead, divided by 250,000 inspections. You also happen to get 10 cents. Now, that's just a coincidence, right? That we got the same number for both. It's not always going to work out that way. I think they're just trying to make it easy on us. But now that we have the overhead rate, we can apply it to each product. So before we do that, are there any questions? Is there any clarification needed on how we got the rates? Yes.
The second level, if I think like the garbage.
Yep.
With the 800,000.
So we divide the $25,000 of inspection-related overhead costs by 250,000 inspections, which is 170,000 plus 80,000. So that one.
Add the 110,000.
Exactly, because you have to add the activities for all of your products together. So this one would look like this. 25,000 dollars divided by 250,000 inspections. Inspections, there we go. Also comes out to 10 cents. And that 250,000 is 170,000 inspections plus 80,000 inspections. So that's the thing to remember. You need the total activity for all the products combined. Okay, does that make sense, Angelica?
Yeah, maybe.
Okay. Or is it Angelina? Angelica, okay, okay. Great, so we have the overhead rate. Now we can apply it. So now we have to do that per product. So if Polly had how many setups? 750,000 setups, and we're applying overhead at a rate of 10 cents per setup, what does that come out to? $75,000, okay? And then Polly had 170,000 inspections. That's also at a rate of 10 cents. So that comes out to what? 17,000. And then we can add those together and get a total overhead of $92,000 for the Polly product. Right, so once we have the rate, you have to multiply it by the activity. But you have to do each activity separately. So if we go on to Silk, Silk had 250,000 setups times 10 cents per setup, which comes out to how much? 25,000. And then they had 80,000 inspections at 10 cents each. That comes out to 8,000, right? Dollars, which gives us a total for Silk of $33,000. Now, one way to double check our work, if we added those together, it would be a total of $125,000 of overhead, right? And remember, there was $100,000 of overhead for setups, 25,000 for inspections. So 125,000 was the amount of overhead we were working with. What we've done is we split up that 125,000 and applied it to each product based on that product's activity. Okay, so because we got 125,000 here, and we started with 125,000, that helps confirm we did it right. All right, so this was again 2 products with 2 activities. Basically, I'd say twice as hard as doing the traditional method. Okay, but you're going to get better at this to the point where you'll be doing 5 activities and multiple products with no problem. All right, are there any questions on this exercise? Yeah, Hira.
For the twice as Silk, how did you get it down to 25,000 instead of the 25,000?
For which one?
For the twice as Silk, 25,000.
Yep, okay, so Silk had 250,000 setups, and we multiply that 250,000 by 10 cents per setup. And then they had 80,000 inspections, and we multiply that by 10 cents per inspection. And then we just add those together.
Mr. Williams, is there a way to do this based on like getting the ratios of like the Polly and Silk to the total?
Sure.
Because we already knew it was on 25, and then I just thought because it adds up to 92 and 33. If you didn't use the overhead rate, it would still have the same percentage to the total.
Yeah, you could look at this using ratios. And if your mind works that way, it might be quicker. I think a lot of us have to go through step by step. So we don't get confused, but yeah, you're right. You could do it a different way. All right, so let's see what's next. That was exercise 9. I don't know what happened here. Somehow I went backwards.
Like 27.
Okay, exactly. Thank you. So that's where we were, and this is where we are. Okay. So we've kind of talked about this, but let's review. As I mentioned, this is not GAAP compliant. This is not for general consumption. This is for internal use. So why do we even need to go through this process then if it's not going to end up on our financial statements? Yeah, it's really for the benefit of the managers, right? So they can have a better understanding of their costs and more accurately see how the overhead is being applied. Okay. Oh, are we already up to absorption costing? Wow. Yeah, told you it's kind of a short chapter. So before we get into absorption costing, I just wanted to see, does anyone have any questions? Of course, in the exercises and problems, we're going to be doing some more practice of what we just did. Anybody have any questions or comments before we move on to a new topic? All right. Well then, absorption costing. Okay, as I mentioned, that's what we already do. The word absorption is used because we're absorbing the fixed manufacturing costs into our cost of goods. And that's what we normally do, right? Our fixed overhead costs are always part of our calculations so far. So for example, to figure out our production costs, we look at our direct materials, our direct labor, and our manufacturing overhead. And we know the manufacturing overhead has some variable components and some fixed components, right? And that method that we've been doing all along is just called absorption costing. But the reason it's absorption costing is it differs from variable costing. Now, variable costing is not GAAP compliant. So again, it's not anything that we would be sharing outside of the organization, but it does give a different perspective because if you're a manager with no control over fixed costs, then you don't really care about the fixed costs, and you'd be interested in seeing what your costs are just from a variable perspective, because that's what you control. So that's what we're going to get into now. Here's a simple example. In this case, we see absorption costing, we see variable costing. And you notice the material costs are the same, the labor costs are the same, the variable overhead is the same. The only difference here is the fixed cost is included under absorption, but it's not included in the finished goods inventory under variable costing. So we just take those fixed manufacturing overhead costs out. Now, on a variable costing income statement, you do include those costs further down, but you just don't include them at the top where you're figuring out your finished goods inventory or your cost of goods sold. So here we see examples. Here's a very simple income statement. This is what we're used to. Sales minus cost of goods sold is your gross profit. Yeah, okay. And then we got net income here. Now the fixed overhead is included in cost of goods sold, right? That's the normal method. But what if we took that out and moved it down here? Okay, well now we got sales minus cost of goods sold, variable cost of goods sold, is our gross profit. So you see, we have a higher gross profit. If we are a manager that has no control over fixed costs, we like variable costing. It makes us look more profitable, right? But of course, you know, we do have to account for those fixed costs. We just move them down here, and we do get the same net income in both of these cases. Okay. So far, pretty simple, right? Nothing too complicated. We're just moving our fixed costs. All right. Well, it does get a little more complicated. So let's see what's going on here. Under absorption costing, again, our normal approach. We've got material, labor, variable overhead, and then $9,600 of fixed overhead costs that went into our cost of goods sold. So it's no longer 12,000. In this example, it's 9,600 because some of those fixed costs we're allocating to our goods that we sold. But some of them got applied to goods that have not been sold. And they ended up as part of our ending inventory fixed overhead. So this absorption costing method generally makes us look more profitable overall because some of the fixed costs shifted off into cost of goods sold for the next period. In variable costing, let's see. They just left that $12,000 off of this whole calculation, right? So here under variable costing, there's no fixed overhead cost here. So we end up with a lower cost of goods sold, which again is going to make us look more profitable there. But we're going to have to account for that entire $12,000 cost down later. So it's kind of weird. It's really just shifting things around in time. And again, that's why you would never share this outside of the organization, because your investors would be confused and you could be accused of committing fraud by confusing them with non-GAAP compliant information, right? So as we see, the net income is higher than under absorption than it is under variable. Now, what's the difference? How much of a difference are we talking about? $2,400, right? Now we see the $12,000 of fixed costs here. They did show up in this calculation. They just didn't show up in this part. And we see $9,600 of fixed costs here that weren't included here. But the other $2,400 of fixed costs, again, got shifted off into the next period because they were part of the finished goods, not part of the cost of goods sold. And the finished goods, we're not going to count that cost until they get sold. Okay, this one always confuses me. It made sense when I was looking at it yesterday. Let's see if it still makes sense today. Okay, we've got two scenarios. We have variable costing here. We have absorption costing here. Notice, in this first year, they both came out the same, but they also had no ending inventory. Now, in the next year, the company did have some ending inventory. So that shifts those costs out of this period. Because again, we can't count those costs until we sell that inventory. So if it's still hanging around, we still have that inventory, it's an asset. So that means that for absorption costing, we end up $3,000 more profitable because we shifted some of those costs into the next period. So in year 2, we broke even under variable costing, but we had a $3,000 profit under absorption costing. And then in year 3, well, that $3,000 gets sold, and so those costs do end up showing up over here. And that does reduce the profits for year 3, but you see a variable, because they already lost that $3,000 here, they end up more profitable the next year. So it's shifting things around in time. Okay? The basic thing to remember is variable costing is going to make the production manager look more profitable, but the company overall look less profitable. Okay, that's what it boils down to. But it still has value, and that's why we would still do it. Okay, now when we're dealing with variable and absorption costing on a per unit basis, it's really simple. And I think that's what this is right here. Yeah, but let's go ahead and work through this together. And you'll see how easy it is per unit. So this company, as it says, is making 7,000 units. All right, let's make that bigger. Okay, 7,000 units. We are trying to figure out the cost per unit under both variable and absorption. So let's do absorption and variable. Okay. So we'll do direct materials, direct labor, manufacturing overhead, and total. Okay, this is just for us to practice here. Okay, so it says the material costs are $10 per unit. So that is going to be the same in both cases, right? Because really the only thing that changes is the overhead. Oh, actually, I should put variable. Variable manufacturing overhead and fixed manufacturing overhead. Okay. All right, so our direct labor, it says, is $9 per unit. Again, that's going to be the same in both cases. Variable manufacturing overhead, it says, is $3 per unit. That stays the same in both cases. And then fixed manufacturing overhead, well, the total is 49,000. Exactly. If they're planning to make 7,000 units and the total overhead is total fixed overhead is 49,000, we just divide, right? $49,000 of overhead divided by 7,000 units comes out to $7 per unit. So for absorption costing, we will include that, but not for variable, because we're only looking at variable costs, not fixed. So then if we add them up, $29, thank you, for absorption is the total cost per unit, and $22 is the variable cost per unit. Pretty simple, right? It's just a difference of, do we include the fixed manufacturing overhead per unit or not? It's only when we start to look at it total for a period and then compare it with other periods or compare it between variable and absorption, that's where it gets a little tricky. But on a per unit basis, it's really not too complicated. Any questions on the slide? Okay. All right then. Ooh, another exercise. Okay, I'll stay right here. And let's go to 15. Okay, so this is going to be similar to what we just did because we are doing per unit costing, variable, and absorption. Starting with variable. Our direct material cost per unit, it says here, is $240. What is our labor cost per unit? 280? And what is our variable manufacturing overhead per unit? 100. So we add that together, $620. Is that right? Okay. That's pretty simple, right? Just plug in the numbers and add them up. Okay. And we did not include any fixed costs there, right? It's all variable. So now with absorption costing, we are going to include fixed costs. So we're talking about 10,000 units. See, it says production 10,000. That means we're producing 10,000 units. And the fixed overhead is 1.2 million. So we divide 1.2 million by the 10,000 units. We get $120. Is that right? I'll double check. Okay, 1.2 million divided by 10,000, $120. Okay. All right. So now that we know our fixed cost per unit, we can again take our direct material, our direct labor, our variable manufacturing overhead, and we add now our fixed manufacturing overhead, add it all up, and under absorption costing, our per unit cost is $740, not $620, right? Because now we're including the fixed overhead. Okay, I know I went through it kind of quick, but I think it's pretty simple. Any questions? Okay, so let's see what's next. We only have a couple slides left. And now we have a problem to do. Okay, let's go to the problem set. Okay, we're going to do problem number 3. Okay, so now we're shifting gears. We're going back to ABC costing. All right. Is that the last slide before the summary?
One more.
Oh, there's one more, problem 8. Okay. I wonder why they threw these in here at the end. Okay. All right. So basically, we'll come back to absorption and variable costing. Okay. We are going to have some challenging exercises and problems related to that, but now you can forget that topic and let's go back to ABC. And starting with problem number 3. All right. Pretty long problem. So this company makes picnic tables. They have estimated these 5 different overhead cost pools. Okay. Those are the 5 cost pools. And these are the drivers for each cost pool. So for example, there are 700 orders that they're anticipating that relate to $70,000 of purchasing costs. Okay. We have 1,334 material moves that relates to $33,333 of handling material costs, right? So this first table is the costs, and the second table is the activities. Got it? Okay, they got an order for 1,000 tables. We have to figure out what's going to be the cost of that order using the ABC method. Our direct labor cost is $20 per hour. We will need that information. And we see our material costs here. They just gave us that number. Then we see, let's see. I'm not sure if we're going to need machine hours in this case. We are going to need the direct labor hours, and we are going to need the activities. Remember how we had these 5 different types of activities that they estimated? Those are the total estimates for the entire period, right? This is how many of those activities are estimated for this job. So we will need that information. Okay, where do we start? Well, we start with taking our estimated overhead, which we can get from the first table. These are the 5 different overhead cost pools. And I'm just going to copy and paste to save a little time. Then we will put in the different cost drivers and the activities associated with them. That is from the second table. So again, I'm just going to copy and paste these 5 different drivers and activity amounts. So we end up with this. Okay. And now, what do you think we have to do next? Exactly. We're going to take our overhead cost divided by the estimated activity. So it comes out to $100 per order of purchasing costs. Then for materials, we'll call that $24.99 for each material move. $4.70 for each machine setup. $5.10 for each inspection. And 25 cents per square foot for utility costs. Okay, so now we have 5 overhead rates. Any questions so far? Okay. All right, well now, this is where we're going to add up the cost for this particular job. So we're going to start with materials, and they gave us the material cost as a total. $112,700 of materials. Now, direct labor, they said the rate was $20 per hour, right? And 5,300 direct labor hours for this job. So we take the 5,300 direct labor hours, multiply by the $20 per hour cost, and we get a total labor cost of $106,000. Okay. Any questions so far? All right, so now the number of activities. Remember, they gave us that information here. So for this job, it's going to be 60 purchase orders, 800 material moves, etc. So I can copy that and put that right here. And then do you remember how we just calculated those overhead rates for each of those different activities? You can copy that. All right, now what do we do? Okay, we're gonna have to multiply. So we take 60 purchase orders times $100. Was that 60,000? All right. Or 6,000. 6,000. Okay. 800 material moves at $24.99 each. 19,992. 100 machine setups at $4.70. That would be $470. 450 inspections at $510. 2,295. And then 8,000 square feet at a quarter per square foot comes out to $2,000. So now we have our material cost, our labor cost, and our 5 different overhead calculations for this job, which we can then add up, and we will have the total cost for that job. So $249,457. Okay. So as you see, it's really not that different from what we've done in the past with overhead. It's just we have to do it multiple times, right? Because we have multiple cost pools and sometimes multiple products. Right? Any questions on this problem? Okay. Well, we have one more problem before we summarize our chapter, and let's see what that one is. Problem 8. Okay. Okay, in this case, we are going to first do traditional costing, and then we will do ABC. And we'll see what's the difference that we come up with between the two. So it says the company traditionally used machine hours. But now they've collected this information. They've got these 5 different activities. Oh, actually 3. 3 different activities. They've got the estimated cost, the estimated overhead cost associated with each of those activities, and then the estimated activity for each product, and they've got 2 products. We also have the machine hour information, because that is their traditional method that they used, and how much of each product they're producing. Okay. So let's start with traditional. How much overhead would be allocated to each unit? So what is the overhead cost per unit using machine hours? Okay. So for right now, we don't need to worry about ABC, so you can ignore those 3 rows. This is what we need right here. And the one other thing we need is their total overhead cost. How do we figure out their total estimated overhead? Is that? Add is right, but not the production volume, because production volume is the number of units that they're going to produce, right? We're trying to figure out what is the estimated overhead cost total. Yep. What they gave us here is the 3 different cost pools of overhead. So if we add those together, we'll know the total estimated overhead. Make sense? Okay. And so they were a little sneaky there because they didn't give us that information, and they're making us work for it. But that's the way they are. Okay, so that means our total overhead that we're working with is this $210,750. And in traditional overhead costing, that's all you need. God bless you. You need the total, right? So if that's our total overhead, which I'll put it right here, estimated manufacturing overhead equals, what did I say? 210, 750. Okay. Then to get our rate, what do we need to do? We need to divide it by our estimated activity, right? What activity are we working with? Machine hours. Okay, so production is going to be part of it, but how do we figure out how many machine hours we're expecting to use? Okay. Yes, so if we take 4 machine hours times 750 units, that means for product 1, that's going to be 3,000 machine hours, right? 4 times 750 equals 3,000. I'll just put it right here for reference. But what about product 2? Yeah, we're going to take 3 machine hours per unit times 1,500 units. That means it'll be 4,500 machine hours for product 2. Got that? The number of the activity times the number of units you're producing gives you the total activity for that product. But then we need to add it together for both products to get our total estimated activity. So what is that total? 7,500 machine hours. So we're talking about this much overhead divided by this much activity, and that gives us our rate, which comes out to 2810. Exactly right. What does that mean, 2810? So $28.10 of overhead per machine hour. Okay, so even though the formula is really simple, estimated overhead divided by estimated activity, well, they made us work to figure out what is the estimated overhead. And then they made us work some more to figure out what is the estimated activity. And then we could come up with our rate. But now, oh, let's see. Oh, okay, now the question is, how much overhead would be allocated to each unit? So notice we have product 1 and product 2. So what would be the overhead for 1 unit of product 1? That okay? How'd you get that, anyone? You divided the estimated overhead by what? Yeah, that doesn't do it, unfortunately, because we already have a rate, right? So we don't have to worry about that estimated overhead anymore. But that rate is per machine hour, right? What we need is per unit. So how do we get from per machine hour to per unit? If it's $28.10 of overhead per machine hour, what would be the overhead cost for 1 unit of product 1? Yep. There are 4 machine hours in each unit of product 1. So to get our answer, we need to multiply that rate by 4. And that means we'll have $112.40 of overhead for each unit of product one. Okay, did anybody have that answer? Yeah, you got it, Christina? Yeah, good job. Okay, well, now that you get it, right, I think you'll get product two. How would we know our manufacturing overhead per unit for product two? Times 3, right? We take the rate, which is per machine hour, times 3 machine hours. And that comes out to 84.30. Okay. So those are our answers for part A, which is the traditional method, and the easy part. We double check them. We said, where is it? Yeah, 112.40 and 84.30, right? Yeah, okay, good. Okay. Any questions on those calculations? Do you want me to review what we just did? Do you want me to go back over it step by step? No, okay. That's fine. I didn't really want to. I should stop. Okay, so let's go on to B. Now we're using the activity-based method. And here we've got our 3 different cost pools. We have to divide them by the activity for each of those cost pools in order to get a rate. Okay, so let's start with machine setups. How many machine setups are we expecting?
60.
60. We're expecting 15 for product one, not per unit, but just total. So 15 machine setups related to product one, 45 machine setups related to product two. So we'll add those together, and yes, that comes out to 60. Now for the assembly of parts, it's 3,000 per product type, so we'll just add those together, we get 6,000. Activities. And then for packaging pieces, see, it's 500 for product one, 400 for product two. That's a total of 900 packaging pieces. So that's the total activity. What do we do now?
Divide.
Now we're going to divide. So the overhead cost in each cost pool divided by the activity, the total activity for all products, comes out to $180. Then for assembly parts, $24.10. And for packaging pieces, $61.50. Okay, so now we have an overhead rate for each of those 3 different cost pools. Take those rates and we're going to move them down to the next table. And then we are going to multiply them by the activity for that particular product. So do you remember machine setups? It was 15 for product one, 45 for product two, right? So we'll take 180 times 15 for product one. And 180 times 45 for product two. Then we'll do the same thing. Assembly was 3,000 each. 2410 times 3,000 parts to assemble comes out to 72,300. So that's going to be the same for product two. And then for packaging, we had 500 for product one, 400 product two. 6150 times 500, 30,750. And then 6150 times 400. 24,600. Okay, so now we've calculated the overhead costs in each of those pools for each product. Now we can add them together. $105,000 for product 2. And then product 1. $105,750. Okay. Now we know the total overhead cost for each product type, right? But to get it down to a cost per unit, we need to divide by the number of units. So we're planning to make 750 units of product 1, 1,500 of product 2. So once we divide, we get $141 of overhead cost per unit for product 1. And $70 per unit for product 2. If we compare that, pretty different from what we got with the traditional method, right? So again, it might be worth it to do the extra work and look at the ABC calculation. All right. We are right at 240. I mean, yeah, 240, that's right. All right, so let's take our break and I'll see you in 10 minutes.